Today I'm going to go over some interesting material. I had to dig deep into the Federal Reserve H41 statistical releases to uncover this, but I think the effort was worth it. After all, one of the finer points of understanding the price movements of gold, equities, and bonds is to understand the soundness of the currency in which their price is quoted. Misunderstand the soundness of the currency, and no amount of additional analysis will explain long-term price movements. As I've covered in some of my recent videos, we've seen an amazing increase in the Federal Reserve balance sheet not seen since the response to the 2008-2009 financial crisis. Over the past 7 weeks, we've seen the assets held by the Federal Reserve increase from $4.2 trillion to $6.3 trillion. This blue curve shown here against the left axis represents the purchase of more than $2 trillion worth of assets in a very brief period of time. We've also seen a pretty big increase in the currency in circulation, shown in red against the right axis. Currency in circulation has increased by nearly $88 billion over the same time frame. But let's compare these two factors according to their relative percent changes. If we take a look at the currency in circulation, we can see that it has increased by nearly 5% in 7 weeks. This is a pretty rapid change for base money. Annualized, it would be a 42% rate of increase. This is certainly shocking, but not nearly as shocking as the rate of increase in the Federal Reserve balance sheet. When we look at bank credit, we can see that it has increased by 49% in 7 weeks. This is an absolutely amazing change. When annualized, it works out to be 1,887%. In other words, if the Fed keeps up this pace of asset purchases, we would expect in a year's time they would hold nearly 20 times the assets that they hold now. This would be $80 trillion worth of assets, which is 3 to 4 times the current U.S. national debt. So the critical question that needs to be answered right now is, why has all of these asset purchases not resulted in an increase in the base money supply? Let's dig in deeper to find out. I copied numbers from the Federal Reserve H41 statistical releases from April 15th and February 26th into a spreadsheet to do a side-by-side comparison of the asset register. On the asset register, you can see what kind of assets the Fed holds as reserves. Please pause the video anytime you wish to study these numbers. At first glance, they can be somewhat dry, but the further you dig into them, the more interesting things become. I'd like to make a few comments about these numbers. First, notice that out of the current $6.3 trillion asset balance, $3.7 trillion, or more than half, is made up of U.S. Treasury bills, notes, and bonds. The percentage used, it used to be much higher during the days before the central bank was, this interventional. The rest is made up mostly of mortgage-backed securities and central bank liquidity swaps now. The gold stock shown here is actually about 40 times smaller than it would be if gold was marked to market. Currently, the book value of gold is about $42 per ounce, which is the statutory price. If gold was marked up to the market price, then the value of the gold held in the form of gold certificates would be over $400 billion, a reserve of somewhat less than 10% of the total. I've highlighted what I think to be interesting changes in blue. Notice that of the roughly $2 trillion increase in assets between February 26th and April 15th, about $1.2 trillion were U.S. Treasury purchases. The nominal Treasury bonds held by the Fed increased by 55%, and the inflation index bonds increased by 66%. Of the 49% increase in Fed assets, about 28% of that came from Treasury purchases. There was also an increase in mortgage-backed securities held. This increase was about $100 billion and represented a 7% increase in this type of security held. While interesting, it really only represents about 2% of the total 49% increase in assets. Then there are central bank liquidity swaps. The nearly $400 billion increase in this account represents loans made to foreign central banks. This account was very small in late February. The loans account for almost 9% out of the 49% total increase in assets, and so they are surely material. This account itself increased by 873,000%. Now, against every asset on the balance sheet is a liability. So let's take a look at the Federal Reserve liabilities. Here I did the same thing. I took the numbers listed in the February 26th and April 15th Federal Reserve statistical release and compared them side by side. Here we can see that the total liabilities very nearly match the total assets on the prior slide. Any discrepancy is likely to be round-off error. Again, you can pause the video and study this table, and you can learn a lot by doing so. I highlighted in blue the interesting features of the table. These line items represent the majority of the 49% increase in total liabilities. Notice that currency in circulation, which is essentially the Federal Reserve note, increased by 5% over the past 7 weeks, but that this represents only 2% of the total 49% increase. One has to ask the question, why is all of the asset purchases by the Federal Reserve not causing the currency in circulation to explode? After all, traditionally, when the Federal Reserve monetized assets, it would do so by creating new Federal Reserve notes that didn't exist before. I thought long and hard about this over the past several days and poured through many tables of numbers. I finally figured it out. Let me show you. Notice that of the total 49% increase in Federal Reserve liabilities, 42% of it comes from two categories. The first is the U.S. Treasury general account, and the second is the reserve balances with Federal Reserve banks. Let's explore the U.S. Treasury general account first. To explain what this account is, it is a deposit account that the U.S. Treasury has with the New York Fed. It has a certain amount of currency on deposit with the New York Fed that the Treasury can draw upon at any time for spending purposes. And here's how the balance of that account has evolved over time. It was very small prior to 2009, but has been growing quite quickly since then. Up until 2016, it generally varied between $50 and $100 billion. Between 2016 and 2020, it has generally fluctuated between $100 billion and $400 billion. You can note that the balance has been drawn down generally during times of budget wrangling between the two partisan halves of the House of Representatives. But over the past 7 weeks, this balance has increased by $450 billion and is now very close to $900 billion. What happened? Well, the Treasury sold bonds to the Federal Reserve, received the newly created Federal Reserve notes, and then just deposited the funds into its account at the New York Fed. So this activity does represent $450 billion of freshly created currency, but the currency has not yet been spent into the economy. Once this money is spent, it will increase the currency in circulation by about 25%. So the fact that the money has been put aside for later has acted as a sort of pressure relief valve. Now, let's focus on the other large increase in Fed liabilities, the deposits with Fed Reserve banks. Here we see a plot of deposit balances over time starting in 2003. We can see the rapid increase starting in 2009. This was Bernanke's helicopter drop to save the economy. Many people thought that his actions would lead to hyperinflation, but that didn't happen. The main reason was that the money was created and kept on deposit at the Fed rather than the money being spent into the economy. The increase in the total amount of Federal Reserve notes culminated in a peak in 2014. Afterwards, the deposit account was reduced as certain assets such as the holdings in the Maiden Lane entity were rolled off. Still, even as of early 2020, this deposit account was not yet brought down to pre-crisis levels. After all, there were still plenty of mortgage-backed securities on the books, which were still assumed by the Fed. But now focus on the past 7 weeks. We can see the sudden $1.3 trillion increase in Reserve Bank deposits. This is absolutely huge and has now brought this account to its highest level in history. So what's going on here? Let's dig a little deeper. In the H41 weekly report is a statement showing the assets and liabilities of each Federal Reserve Bank individually. It's Table 5 for whoever wants to look it up. Here I've summarized the ledger entry shown as other deposits. The reason why I'm focusing on which banks are most active will become evident in a moment. We can see the $1.3 trillion increase over all of the banks combined. It's a little odd to me that this table is showing an increase that is $90 billion higher than the other tables indicate. But I did find some math mistakes in some of the other tables as reported, so it's entirely possible that there are mistakes here as well. In any event, notice that in this table, the other deposits account has increased by 83% over the past 7 weeks. And that's a full 43% and a full 43% of that has been due to the activity of the New York Fed. We've seen some very significant activity out of the Richmond Fed as well, but I'm going to focus on the New York Fed because I'm aware that this particular Federal Reserve Bank has accounts earmarked for very specific purposes. I'm sure that if I dug into the Richmond Fed, I'd find some interesting things as well. But it's Sunday, and I want to get this video published for your benefit before the numbers change yet again as we enter into the new week. So with that said, let's go to an explanation given by the Federal Reserve itself as to what this other deposits account consists of. And here we have it in the Fed's own words. Other deposits at the Federal Reserve banks include balances of international and multilateral organizations with accounts at the Federal Reserve Bank of New York, such as the International Monetary Fund, United Nations, International Banks for Reconstruction and Development, the World Bank, the special checking account for the Exchange Stabilization Fund, where deposits from monetizing SDRs would be placed, and balances of U.S. government agencies and government-sponsored enterprises, such as Fannie Mae and Freddie Mac. Also includes balances of financial market utilities that are designated as systemically important by the Financial Stability Oversight Council under Title VIII of the Dodd-Frank Wall Street Reform and Consumer Protection Act. Also includes deposits held by depository institutions in joint accounts in connection with their participation in certain private sector payment arrangements and certain deposit accounts other than the U.S. Treasury General Account for services provided by the reserve banks as fiscal agents of the United States. So now we know how all of these assets were bought without it resulting in a tremendous increase in currency in circulation. $450 billion is freshly created money that has yet to be spent by the U.S. Treasury. And at least $700 billion, and maybe more, are already existing Federal Reserve notes that have been deposited with the New York Fed by entities such as the IMF, the UN, the World Bank, the Exchange Stabilization Fund, and the FSO. So, although this resulted in the purchase of assets by the Fed, it didn't create fresh money. It only moved it. So this, ladies and gentlemen, is the reason why the price of gold has not yet exploded. Freshly created currency is much less than the asset register of the Federal Reserve would suggest. Most of it has already existed and is just being moved around. Of course, we do have this issue of all the funds the U.S. Treasury now has available to mobilize. We'll have to wait and see what the President and the Treasury Secretary do with it. Stay tuned.